Good morning from our global headquarters in New York. I'm Manus Crenny. Welcome to Bloomberg Brief. Let's set your agenda. Stocks stabilize after a tech-led pullback. Investors count down to the macro event of the week, NVIDIA. A message from China. From e-commerce to commodities, the warning signs pile up. And U.S. National Security Advisor Jake Sullivan touches down in Beijing for a 3-day visit. Some people say when the conduits of communication are open, that's the critical point. This market is building up the biggest macro event, which is NVIDIA. Get ready potentially for a 9% swing on the day. That's nearly $300 billion. We pull it back. We were down 1% yesterday on the NASDAQ. We pull it back up by its bootstraps this morning. The S&P 500 on the equal weight made a new all-time high yesterday. Bank of America suggests that that new all-time high on the equal weight is a pivot for broadening. I want to work at the Goldman Sachs buyback desk. That's actually my version of Nirvana. The phones are just ringing off the hook. They have been inundated with buyback calls. They also say that you're getting a $17 billion of unemotional, I love that, unemotional demand between robots and corporates. So that's going to build to the pillar there in the equity market. The bond market, again, the narrative from Mary Daly, along with a number of others, is building up that the time has come. Dial back is the narrative from Barkin. It's going to be hard to derail the September cut, except the IB chat that I've literally just had with somebody in the Middle East who's a bond broker. He's saying, actually, we're all focused on NVIDIA. It's the most boring start to the week that we've ever had. But if NVIDIA disappoints in any way, it will reignite the fury in the rate market for a 50 basis point cut. Go figure. Oil is down by 0.5%. Goldman Sachs, Morgan Stanley, both really taking the side to their estimates. Goldman's cuts Brent to $77. They say the surplus that's going to come back from the OPEC Plus add back into the market is going to be a penalty for those other non-OPEC producers, strategically disciplining the market with OPEC supply. So that is your risk-ometer. The key event will be NVIDIA. Fed speak. San Francisco Fed President Mary Daly spoke to Bloomberg about whether it's appropriate to, you got it, time to cut rates.
Well, to my mind, we've been on this path of ready to adjust policy rates for several months. We just needed to get a little more confidence that inflation was truly on its path to 2%. And I wanted to see the labor market come into balance, but I think that's completely happened. And the risks to our goals are now balanced, and the time to adjust policy is upon us.
The time is upon us. The time is now. Dan Morris is the Chief Market Strategist at BNP Paribas. And you add into Barkin, it's time to dial down the rates. Dan, good to see you this morning. How high or how low is the bar to a 50 basis point cut in September?
Well, I think always the market doesn't want to be surprised, and there's going to be an assumption that if they actually do cut 50 without some economic data between now and the actual meeting to justify it, there'd be the worry that, oh, does the Fed know something that we don't know? Are there further signs of weakness that we haven't come across yet? So that does seem to be a bit more in line with a swifter slowdown to growth than we currently see. And I don't think the Fed is going to want to surprise the market in that way. So we think the bar, to answer your question, is relatively high, and the Fed will probably be happy with 25 basis points.
And we're going to count down to the jobless claims. Never have weekly jobless claims been so excited and so focused on. But before that, we get NVIDIA. I said at the start that NVIDIA could be the redefining of the rates risk. We're getting ready for a 9% swing around on NVIDIA. Correlation is something like at 78%, according to Bank of America. How important is the NVIDIA results for the narrative of cuts and momentum?
I would say not terribly. I would hope that the Fed is not making its decision on the outlook for policy rates based on the results for one company. We think broadly the outlook for tech, for NASDAQ, is positive. The outlook for the economy is good. Certainly anyone who's very heavily exposed to NVIDIA is going to care a lot. But for us, it really wouldn't fundamentally change what we anticipate through the end of the year, which is for further gains, and particularly for NASDAQ.
Okay, so you're not that attached to it. It's going to be one of those swing events in the market. But one thing for sure is that the 60-40 portfolio has performed. It really has performed. It's at a record over the past couple of days. And I just wondered to what extent you look at that kind of performance in the traditional model, and you sort of say, okay, so bonds are now doing what they're supposed to do in this construct. When you look at 60-40, how does that bear out for you?
Well, in fact, we're actually looking for other assets, if you will, to provide the diversification that typically you look for in the 60-40 portfolio. If we think about the prospect, particularly for U.S. Treasury yields in the future, inflation risk in the event of a Trump victory, regardless of who wins, we should and are concerned about debt levels and so on in the U.S. That would argue for higher yields, and perhaps, therefore, you don't get that diversification benefit. Therefore, we've been adding to our allocation to gold as a way to hedge against those inflation risks, those debt level risks, the geopolitical risks, and that seems to be the better way to look for a hedge for a multi-asset portfolio.
And just how much have you been adding? I mean, obviously, we made a new record. We touched through 2,500, etc. So just how much more gold are you adding?
Well, in our multi-asset portfolio, it's the biggest overweight that we have. Always evaluating how that looks given the performance that we've had, but that's our position today.
So the dollar has collapsed, over the past month, 3 months. You've broken through the 200-day moving average. It's one of the biggest drops below the 200-day moving average in more than a year. Now, yesterday's conversations, I had Bank of America saying, look, this dollar drop, this crumbling in the dollar is just overdone. When you see that kind of collapse in the greenback, what does that flag to you, and what does it deliver for you?
Well, we don't have a specific dollar allocation in the portfolio, but actually it's implicitly reflected in the allocation to gold, because typically a weakening dollar is positive for gold, and conversely a strengthening dollar negative. Now, that hasn't been the case for much of this year because you had all these other factors, particularly the hedging properties of gold, that have overweighed the drag that you would anticipate from the strong dollar. Now that you've got the dollar weakening, it's just added another impetus to the support for gold prices. So implicitly, that seems to us the best way to take advantage of the weakness in the dollar.
So if NVIDIA is not going to bear terribly on your thinking in terms of your allocation to tech, how much of that growth allocation is going to be determined whether you get 3 or 4 cuts from this Fed? Well, it could be 3 cuts and 100 basis points, I grant you. But to what extent is the allocation to growth predicated on a cutting cycle?
Well, certainly that's implicit in the price action that we've already seen. I think always when you know you're on a slowing path for U.S. growth, because implicitly the story this whole year needs to be that U.S. growth slows, otherwise you're not going to get inflation back to target. That's all well and good. That's probably what the data supported. But there's always that risk that that slowdown goes too far and you do tip into a recession. Now, at this point, we see that risk as relatively low. Of course, it's never zero. But unfortunately, we are still quite data dependent, and we're going to be watching what we get for non-farm payrolls, what we see on the unemployment claims to see if that deceleration is accelerating. That certainly would change the outlook and our allocation. But for the most part, for now, we do think it is going to be a slowdown to a soft landing, which what leaves us overweight to NASDAQ in the U.S.
So if gold is your hedge, a soft landing, no recession is your base case, what's the biggest risk that you're taking?
I think it's, in terms of the biggest risk, I think it would be that you do see that surprise slowdown in growth. I mean, if we appreciate that really everything since the pandemic has been unpredictable because it has been an experience that no model could take into account since it had never happened before. So I think the confidence level for any honest economist or strategist has got to be relatively low, trying to anticipate what's going to happen. Let's not forget, at the beginning of this year, we had those big inflation surprises, and we were talking about renewed overheating. Now we're back to trend level inflation. Hopefully that persists, but we appreciate really any month that could change again.
That is the joy of pivots. Dan, thank you very much. Dan Morris of BNP Paribas Asset Management with his calls. He's brave. He's not worried about the swing factor from NVIDIA. Well, we are on Bloomberg because we've got an exclusive conversation with the NVIDIA CEO, Jensen Huang. That is special live coverage tomorrow, 6:30 p.m., right here on Bloomberg Eastern Time. Other stories trending on your Bloomberg terminal this morning. This is what we got for you. More changes in the Apple C-suite. It's the longtime CFO, Luca Mastri, will step down, and that's at the end of the year. He will be succeeded by a top deputy. Kevin Parek. Apple's management team is likely to see some more changes in the foreseeable future, with many of its executives at around 60 years of age. Skydance is set to become the new owner of Paramount after Edgar Bronfman dropped out of the bidding war. This ends one of the industry's most dramatic acquisition contests. The deal is expected to be completed in the first half of 2025. And it's no longer a definitely maybe. Oasis has confirmed that they will reunite for a tour starting next July in Cardiff. Now, that's in Wales. It's the Britpop band, and they split 15 years ago. The brothers basically could barely be in the same room as one another. It's not going to be on TV. You're going to actually have to buy tickets to go. And it's a real sort of moment of angst for all the fans out there. Noel Gallagher, in 2009, when he walked out of the band, he said he simply couldn't stand working with his brother Liam another day longer. The guns have fallen silent, the stars have been aligned, and the great wait is over. Come and see us. We're not on the telly. I want to have a quick check on the yuan. This is one of the most read stories on Bloomberg Television, on Bloomberg Terminal this morning. This is the drop in the dollar, the rise in the yuan. And what we have is a real story about an avalanche. And this is the structural investments by Chinese companies in the U.S., by Japanese companies in the U.S., the pile of repatriation. You could get $1 trillion of FX divestment and an avalanche back into the yuan. This is according to Stephen Jen. And that would move the yen higher by nearly 10%, something that he says the authorities will probably allow a 5 to 10% appreciation. Get ready for the avalanche back into the yuan and maybe even a trickle back into the yen from structural dollar investments. Most read story on Bloomberg. Coming up, the National Security Advisor Jake Sullivan meets China's Wang Yi on his first trip to Beijing. More on the story. That's next. And later this hour, 25 or 50, we'll discuss the Fed's rate cut path with Saidel-Baker of ITR Economics. Context matters on Bloomberg. It is Bloomberg Brief. I'm Manus Cranny in New York. Good morning to you. President Biden's top security aide, Jake Sullivan, met with the Chinese Foreign Minister Wang Yi. This was in the last hour. It's the first visit to China by a U.S. National Security Advisor since 2016. It's been a while. Jill DeCease joins me now. So Sullivan has touched down. Look, a lot has been made out of this. It's been 8 years since he's been there. It's not as if he hasn't met with his counterpart. There's been a series of meetings building up to this onshore meeting, so to speak. Jill, good morning.
Morning. Yeah, Manus. I mean, look, there's a lot that it seems is going to be on the agenda here. So, you obviously just saw some of that tape there of Sullivan meeting there with Wang Yi. He's in for about 3 days or so of meetings. He might meet with Xi Jinping, to be confirmed. We'll have to see ultimately where we go ahead with that. But Sullivan's really here to kind of, reiterate some of the U.S.'s positions on several different issues here. One, obviously, the U.S. is concerned about China's continued backing of Russian forces fighting in Ukraine. That's probably going to come up. I think the Taiwan issue is going to come up. Obviously, Taiwan considers itself democratically ruled island. The U.S. has some relationships there that it's wants to protect, whereas China obviously claims Taiwan as part of its own, sort of its own, sovereignty kind of a thing. And then you also are probably looking at a lot of questions over, a lot of the U.S.'s pushes on, tariffs and other levies on Chinese tech, advanced manufacturing sector, how that's playing into the Chinese economy picture. We just saw, Canada, major U.S. ally there, just implement new tariffs on EVs and stuff like that. So there's a lot on the agenda here, but I do want to point out here, Manus, that this is kind of interesting timing for this trip because, as we've seen, obviously Jake Sullivan is part of the Biden administration, of which Vice President Kamala Harris now running at the top of the Democratic ticket is. But we've actually reported fairly recently that he's not looking to make this meeting, about Kamala Harris or anything like that. But it does, I do want to point out, come at this kind of strange, weird election timing, which I think is potentially could play into this trip here.
Look, everything that happens on the world stage has got a backwash into the political voting that we're going to see in this country. I mean, if you think about the Trump narrative, it has been strong on China, 60% tariffs. The Biden administration continued many of those tariffs. So to a certain extent, one's got to ask oneself whether this is laying the groundwork for a much bigger piece of theater, which would be as Biden exits the U.S. White House. Maybe it sets the stage for that meeting between him and Xi.
Yeah, I mean, that's certainly possible here, Manis. So look, they'll have an opportunity to do that a little bit later this autumn at the APEC summit. So that would really be kind of a swan song for, Biden leaving the administration, no matter who really comes in there. So maybe we're seeing a little bit of work paving the groundway there. But again, I think that with so much focus on the U.S. election and uncertainty about whether it's going to be Kamala Harris or whether it's going to be Donald Trump returning to the White House, that does kind of complicate the picture here. But all that being said, Manis, I mean, look, we've seen over the last 4 years, the Biden administration has gone pretty hard on China on various issues. We've just talked about advanced tech, talked about semiconductors, all these different things where they preserve some of these Trump tariffs. So whoever's coming into the administration in January, you are still probably looking at a fairly strong perspective on China. It's just a matter of in which areas and what that ultimately looks like.
Yeah, and certainly how it sounds along the way before we get any kind of a change in those. Jill, thank you very much. Great content. We'll track Sullivan's journey through China over the next couple of days. Jill DeCease. Coming up in the show, I look at what else is making headlines around the world for you, from the newspapers to Bloomberg.com, right here on Bloomberg. Bloomberg Brief. I'm Manus Cranny in New York. Good morning to you. Front pages, this is what we've got making headlines around the world. First up, Financial Times leads with Zuckerberg. Mark Zuckerberg says that the White House pressured Meta over COVID content. It was a letter to the House Judiciary Committee. Zuckerberg says he believes the pressure was wrong and regrets they were not more outspoken about it. Next up, the Washington Post. More than 200 Republicans who worked for the former President Bush and Senators John McCain and Mitt Romney are endorsing the Democratic candidate Kamala Harris. In a letter, the group said a second Trump presidency will hurt real, everyday people. And Bloomberg leads with the company that owns Temu sending a warning sign on the Chinese economy. Shares in PDD plunged as much as 30% after a disappointing outlook. That is an understatement, to say the least. For more on the PDD results and what it says about the challenges facing the Chinese economy, let's get to Katya Dmitrieva. She joins us now from Hong Kong. Katya, thank you so much for joining us. If you just look at the language around this, revenue growth is not sustainable and a downward trend in profitability is inevitable. Is that because of competition or because of a demand that's cratering? Is it a combo, a toxic combo, or what is the alpha?
Yeah, it's a good question because it's a little bit of both. Unfortunately for the company, you have revenue growth that's slowing, but the stock didn't necessarily react just to that, to this revenue missing estimates. It was more so the forward guidance. There's this really negative outlook on the economy. And for companies like this, you have to think about it, right? When an economy slows, you tend to see an increase and better performance from these kinds of stocks that benefit from that kind of situation, with consumers who are going down, who are buying cheaper goods. And Temu was one of them. It was a darling for a very long time. Made the CEO very rich. And yet demand for that is slowing because not just the economy is kind of slowing in China, but also demand for a lot of these goods and consumer goods in particular, which That's a big question, is whether Beijing can actually stimulate that. And so hearing a company discussing that forward guidance in such a moody, kind of gloomy tone, the executives actually mentioned it about 8 times, this negative forward guidance during their conference call. It's a kind of a negative, definitely a negative sentiment for the economy and for this company.
Yeah, it certainly is, and also a warning on dividends and buybacks as well. That now is not the time. Look, it's not just PDD that we've heard from. Okay, we've got the e-commerce space, but also warning shots from BHP. They're also seeing a siren in the appetite in the iron ore market in the country. The CEO, Mike Henry, caught up with Bloomberg a little bit earlier on the economic recovery.
We believe that the fundamentals remain intact for China to continue its growth beyond kind of its middle income status currently. They're obviously focusing on high quality growth, and we expect that as they do continue to grow the economy, it's going to mean plateauing of steel over time, a constrained iron ore market, but increasing demand for some of the other commodities.
Look, I think Henry just really lays bare what we already kind of know, which is that the housing and the wealth that was built in housing is under pressure. But there was nuggets in this around the miners' earnings as well in copper. But what did it tell us about the real economy in China, briefly?
Yeah, it's the other side of the coin, right? You have a slowing consumer demand, and you also have less demand for things like steel in the property sector. You think of all the condos that have been built or left unfinished. A big part of that is steel. And so if you have this glut of supply, it's going elsewhere. They're not able to get it domestically. No,
certainly pressure coming to bear. Katya, thank you so much for being with us. Wrapping up the stories in China. Coming up, we'll catch up with Lauren Saidel-Baker of ITR Economics on the very latest assessment of Fed speak and the roadmap to PCE on Friday. From our global headquarters in New York. Welcome to Bloomberg Brief. I'm Manus Crenny. Let's set your agenda. Stocks stabilize after a tech-led pullback. Investors count down to the macro event of the week, NVIDIA. A message from China, from e-commerce to commodities, the warning signs pile higher. And the U.S. National Security Advisor Jake Sullivan touches down in Beijing for a 3-day visit. Keeping the channels of communication open there. Likewise with the market, NVIDIA. Jensen Huang will join us tomorrow live on Bloomberg at 6 p.m. in the afternoon. And this is in part the obsession by the market. It is the macro event. We're getting ready for a 9% swing in either direction on NVIDIA, according to the options market. Stocks gave back about 1% yesterday on the NASDAQ, but it almost feels like this market of risk is on a runway, at the beginning of a runway of an airport, and the throttle is fully revved. So whatever happens with NVIDIA could turn the narrative again about a 50 basis point cut in the rates market. It won't define what the Fed is going to do, but it's certainly going to be an element. It's the only thing the rates traders are actually looking at, according to my sources. The equal weight on the S&P 500 made a new all-time high yesterday, and Bank of America say, look, in part, this adds to the broadening and the rotation narrative that they see. I like what Goldman Sachs are saying about stocks. $17 billion of unemotional demand between robots and corporates. I wish we could have unemotional demand every day. NVIDIA is up 0.5%. Get ready for the unemotional flow of money into equities. Bonds are 394 is where we are. Mary Daly says it's time to adjust policy. So again, the call, the narrative, the framing of the narrative, the time has come from Powell. The time to adjust policy is upon us. It's going to be hard to derail a cut in September. Brent is down and it's cascading lower. We'll talk more about this in just a moment. Goldman Sachs, Morgan Stanley cutting their forecast. Goldman's are at $77 for Brent. The surplus is going to mean a harder market to deliver. But this is about OPEC strategically disciplining non-OPEC supply. More on that in a moment with our editor, Will Kennedy, on the oil market. I mentioned the Fed rhetoric. Well, Mary Daly, the San Francisco Fed president, she echoed Chair Powell that the time has come to cut interest rates. Markets now debate how far the officials will go with the easing cycle. Let's take a listen to what Daly had to say.
The neutral rate of interest is of course, constantly debated, and people are thinking about that now. For my own self, I think of it as if we came in to the pandemic at a 0.5 real neutral rate, I can see it being as high as 1 now.
So warning there from Mary Daly on where the real rates lie. Lauren Saidel-Baker is with me, economist at ITR. Lauren, good morning to you. Every day we start with 25, 50, 25, 50. You would say it's a more important thing to stand back and say, what are we going to get in this cycle? And you would say we should brace for disappointment in this cycle. So how bad can it be relative to the optimism of the market? Good morning.
Good morning. Yes, and I am an economist, so I have to be a little bit pessimistic here at least, but we do expect that 25 basis points is the most likely outcome for September. 50 basis points would just be such a huge move out of the gate. I think that would really be the Fed admitting that they should have cut sooner. That said, they're not usually one to knee-jerk react to any one data point. I know we've had just a month or two of soft labor market news. The Fed isn't really looking to catch back up. So what I see as the most likely case is 25 basis points in September. And in his comments at Jackson Hole, Powell did allude to rate cuts in the plural, the path, so-called, of interest rates going forward. So I don't think this will be the only cut. However, I think 100 basis points is really the upper end of cuts that we should expect. I certainly do not expect rates to go back down as low as they were immediately pre-pandemic. This is just a different labor market, a different inflationary environment. And so we will have to adjust from this ultra low interest rate environment that we've all gotten so used to.
Look, I'm interested in your thesis, which is inflation will reassert itself. Now, part of the argument for a number of people is cut too hard, cut too fast, and you could reignite the trajectory of inflation. Why do you think inflation will not resurrect itself, turn higher in 2025? What's the impetus for that thesis?
Sure. The impetus is not only the Fed cutting rates. So there will be some stimulative effect from that. That will encourage higher inflation. But we have a number of other leading indicators that are really already showing the signs of the next inflationary cycle to come. For example, gross Treasury issuance today is actually higher than it was at the peak of that stimulus era, pandemic era spending. And so there's a lot going on. I know we talk about the money supply having contracted, but again, that's very much a leading indicator. We're at such a higher level right now that magnitude is going to be inflationary. So expecting a little bit of softness this year. We've seen that in things like the manufacturing pullback, a little bit of cooling, maybe I'll call it flattening in the industrial economy. But 2025, we already see the green shoots. We see the resurgence of demand. That demand pull on prices will manifest itself. So whether the Fed cuts hard and fast or whether they cut a little bit slower, I do believe the inflation cards are stacked against them. They got so burned with high inflation last rate raising cycle, they really do want to keep one eye on the inflation leg of their dual mandate.
Which then takes us to the discussion. By the way, we were just showing the 5-year break-evens there, which many people have sort of said, actually, now's your opportunity from a market perspective, which I know you're not, to load up on a hedge and perhaps buy those on the take-up. But it takes us to the much bigger debate, which is where, and this is way too intellectual for me, where's the or star? As Larry Summers says, 3% of a neutral rate is just too low. I presume from what you've just said, you may well concur with said Larry Summers, and you're going for a slightly higher or star or neutral rate.
I think this is a moving target. What was true pre-pandemic is certainly not true now. We heard Powell really address the historical nature of this experience, the fact that we all thought inflation would be a little bit more transitory this cycle. I'm not sure it's so much the fundamentals as what non-economic events are hitting us. So things like the pandemic and the echo effects that we are still feeling from the pandemic. Certainly those supply chain issues were unprecedented. So to see geopolitical tensions heating back up, I think that is raising a lot of with the potential resurgence of supply chain concerns. So it's much more of a tactical target at this point. And again, the Fed is aware of that. Their recent focus is shifting from that inflation side of their mandate to the labor side of the mandate. The data fully supports that. So that's why we will see this rate cutting cycle begin. But again, a moving target, it's going to be for the historians to determine what we got right and what we got wrong.
How, if at all, does politics come to bear? You talk about non-economic events. Well, of course, politics and economics are inextricably linked, and one cannot disaggregate them. If you look at some of the narrative from the Trump campaign, which is tariffs, which is around immigration, deportation, etc., and to a certain extent, the the Harris-Walz ticket. What we know, and we know very little so far, is some people would say it is a pro-inflationary narrative as well. But if we take the Republican side, first of all, that's perhaps a little bit spookier for the bond market relative to the Democrats at the moment in the assessment, and we await more detail, of course, on the Democratic ticket.
Absolutely. From a big picture point of view, the good news that I have to give is that there is no statistically significant, consistent relationship between red or blue in the White House and the economy doing better or worse. Now, I mean that from a high level view, so things like GDP, the industrial sector, manufacturing activity. Obviously, things like tariffs, that will skew asset prices in that targeted asset. But from the Trump side of things, I mean, we do see immigration as a potential mitigating factor to this very tight labor market. Even as we see a little bit of directional loosening today, businesses are struggling to hire. We do not have one unemployed worker for each available job opening. We're still at a dearth of workers. That's going to be a long-term trend just due to our demographics in this country. So potentially seeing some implications for immigration there, just in terms of labor availability. Other items like tariffs, it's interesting, both administrations, the recent Trump tariffs as well, Biden tariffs, as well as the prior Trump administration have been shown to use tariffs as a policy lever. Tariffs at the end of the day are, of course, inflationary, so that's another kind of tick in the column for inflation, but something that we've seen from both parties.
When you talk about, and you've referenced the higher inflation at the start of this conversation, as we come to close the conversation, again, you reaffirm that higher inflation. So what kind of propulsion are you talking about? Are you talking about an incremental rise in inflation? You're certainly not talking about a resurrection of inflation back to the very high single digits that we saw at the zenith of post-COVID.
Absolutely not.
Okay.
We saw the consumer price index peak around 9% this most recent cycle. I do not expect to get back to 9%, but I also expect the CPI to kind of touch 2%, not go much below it before it starts rising again into, let's say, the mid-single digits, lower to mid-single digits, but above that 2% target. So inflation will feel different, but again, this is a cumulative effect on our consumer. We haven't lost that 9% gain. We are just seeing prices go up to a lesser degree. So cumulative effect still being felt, still giving a little pressure to the U.S. consumer.
Finally, an economist that admits that we still have to pay the extra 9%. Nobody's cutting the prices there. Let's just square off one thing very, very quickly. So it's going to be a lower and shallower cutting cycle. That's fine. I take that on board. What's the risk of a reversion and having to hike next year?
I think that risk is very real. I do expect that
20%, 30%?
Sorry?
I mean, you say very real. Just quantify that for me. A very real risk that they would have to U-turn next year.
By the end of the year, I think greater than 50% risk. Again, we will see a bit of a flat bottom this cycle, but by late 2025, I would not at all be surprised if we see rates hiking again.
Ah, there you go. Ode to joy at the end of the conversation. Lauren, thank you very much. Tin hats on for the back end of 2025. Lauren, thank you very much for being with me. Lauren Saidel-Baker of ITR Economics. Coming up, the U.S. National Security Council. Security Council Jake Sullivan kicks off his first official trip to Beijing. More on this story next on Bloomberg. National Security Advisor Jake Sullivan meets with his Chinese Foreign Minister Wang Yi in the first visit to the country by the U.S. National Security Advisor since 2016. Jill DeCease is with us. So it's the first time in 8 years that this kind of level of advisor has been in China. How significant is that in the messaging that there's some kind of a meeting, rapprochement between the U.S. and China, even though they have many issues that really clearly divide them, from tariffs to trade to Taiwan?
Well, certainly, Manus, it's important. I mean, look, as you said, we've certainly seen ways in which the U.S.-China relationship has really struggled over the years, deteriorated in many ways. Obviously, Trump, under the Trump administration, launched a trade war against China, but a lot of those tensions have continued under the Biden administration. We've seen a lot of, increased tariffs, other punitive measures, specifically targeting advanced technology in China, manufacturing, semiconductor industries, that kind of thing. This meeting is also coming just as Canada, major U.S. ally, announced some additional tariffs on Chinese EVs, some of those other products. So yes, there's certainly a lot of tensions that remain within relationships between both China and the West, and obviously with the United States, all kind of culminating in this very significant meeting. Now, what does all that mean, Manus? Does it pave the way for some additional meetings between high-level U.S. officials and Chinese ones? We'll have to see. I think, we're certainly looking to see whether that actually means maybe we get a Biden-Xi meeting later this year at the APEC summit or elsewhere. The big complicating factor, of course, in all of that, Manus, is that we've got a major U.S. election this year, and Biden is no longer at the top of the ticket for the Democrats. That's, of course, is Vice President Kamala Harris. We've reported recently that this Jake Sullivan meeting, they want to make clear that this isn't sort of paving the way for any kind of, Kamala Harris. He's not speaking for an incoming Kamala Harris administration should she actually win that vote. But at the same time, we've talked to several analysts who have wondered, is this kind of a way to sort of Trump-proof things with China in the event that Trump actually succeeds in November? We'll have to see what ultimately happens there, Manus.
In terms of what would be seen as a geopolitical win, both of them are having this meeting. Both of them have a lot on the line. We've got lots of messages coming through about slowdown in China. Trump taking to the White House could potentially mean 60% tariffs for China. What is a political win for both sides? Briefly, Jim.
Well, look, ultimately, Manus, I think what China wants to make sure is that there's not any kind of, more aggravated measures, as you just mentioned. There's a lot of concerns about China's economy right now. We did get some pretty good industrial data there, but the Chinese consumer continues to struggle, and anything involving manufacturing, I think, would ultimately be there. So I think that if they can come out of this, maybe paving the way for an additional meeting, maybe that's ultimately what they see as a win here.
Okay, Jill, thank you very much. I know it's wrong to go to the bottom line on what is a win, but they both got to spin it one way or the other with the papers and the messaging afterwards. Jill DeCease on Jake Sullivan touching down in China, 3 days. We'll track it for you right here on Bloomberg. I want to stay with the China theme. You've got shares in Temu owner PDD bouncing back after a double-digit decline. The e-commerce firm's latest earnings flash a warning sign on the Chinese economy. Temu became the market darling of its low-priced goods. For more on the results, PDD's results, let's get to Katya Dmitrieva. Katya, we've touched on this a little bit earlier. This was going head-to-head with TikTok, head-to-head with the other major e-commerce platforms in China. I want to get a sense from you, the numbers and whether it reflects just growing competition or a dissipation in the middle-class pocketbook.
Yeah, it's definitely both. I think one of the new things here, at least for the company, and why the stock seemed to react so much, is just we're seeing the numbers, how the competition is playing out. So yes, they've had competition for a long time from other companies locally, from other tech darlings. But in this case, you're actually seeing it come through in the second quarter results, where revenue missed and we had that big record drop in the stock. What was also interesting is just how downbeat they were on the China consumer. I think we've known for some time that Chinese consumption is slowing, but usually, something I mentioned earlier is when you have a slowing economy, you actually have companies that do really well. And in the US, that's Dollar Tree, it's Walmart. They cater to people, to consumers and households who are sort of moving down the value chain as they get, as their wages move down or flatline, as they could lose jobs, as the economy slows. And in this case, it's quite a worrying sign that you have a company that caters to this demographic that's also seeing some slowness. So it's kind of a sign that not only are consumers moving down in the sort of value chain, but they're also potentially just buying less. And there's other companies recently throughout China that have kind of voiced similar messages about the economy that's things are not looking that great. And it's always good to supplement these sort of company guidance and company information with what we're getting from the government. You know, GDP data is very helpful. We have retail sales numbers, but as you know, they're not as detailed as we get in other countries, in other large economies in particular. So these kinds of company anecdotes and color, they're really helpful. And in this case, they're not very positive.
No, certainly not. I mean, that stock PDD is taking a bath this morning. Katya, thank you very much for being with me. Katya Dmitrieva. Elsewhere in commodity land, oil snaps 3 days of gains amid supply woes and a shaky demand outlook. Goldman's now see Brent averaging $80 a barrel through 2025. Will Kennedy is with me on this. I love the blog this morning. Will, good to see you. Oil is losing friends on Wall Street as OPEC plus supply hike, risked. I mean, to lose friends and alienate people. I know that this is a great story, but this is about supply coming back from OPEC plus, and that's the core of the worry here in the analyst notes.
That's a big part of it, I think, Manus. The background here is that we've had a summer where oil supply has been tight. The world has had a pretty good balance, or perhaps even a slight undersupply in oil, and people are looking into the rest of this year and especially next year. And when you combine OPEC's plan to bring production back to the market with doubts about the economy, especially in China, and robust growth in other parts of the world like the United States and South America, you get balances that are looking a lot weaker for next year. So that's got Wall Street thinking about how things are looking, and a certain pervasive gloom about the outlook into 2025, as you mentioned.
Well, when I look at some of the lines in Goldman's notes, strategically disciplining non-OPEC supply. Now, I think that's interesting because this goes to the heart of the issue for OPEC, which is the ability to move, but they don't want to have an all-out war. I mean, that's what they want to avoid. So that's what they've got to try and balance. If the interest is strategically disciplining non-OPEC supply here in the United States of America, other oil producers will. How finely balanced is that between the all-out price war that we saw unleashed sometimes by OPEC with this balance, this balancing act that Goldman suggests they want to try and achieve?
This has been the strategic dilemma for OPEC for more than a decade now, since we really saw the development of fracking and the boom in oil from the US, is that when they cut production to keep prices robust and to keep the market balanced, it encourages barrels from non-OPEC suppliers. So they're always having to make this balance, and I think they're entering a period where that balance may become trickier still, and it perhaps may be in the interests of OPEC in the medium term to tolerate slightly lower prices to avoid even faster non-OPEC production. But there are many risks. I don't think we should see this as too one-way, Manus. We've seen in recent days how geopolitical risks have come to the fore. The tensions between Iran and Israel remain critical to the oil market and in traders' thoughts. And then again in Libya, where we've seen a threat to close down the majority of oil production and exports from one of OPEC's North African producers, 1 million barrels of oil at stake a day. It shows that, these geopolitical risks do remain, and this is far from a one-way story.
It certainly is, and the market is picking up pace now, down 1% on WTI. That is definitely what you call losing friends on Wall Street. Well, thank you very much, Will Kennedy, Managing Editor for Commodities. Coming up, we'll get you set up for your trading day ahead. Context matters every day from Bloomberg Brief in New York. How does the rest of your day look apart from tracking the Nvidia stock price? The Conference Board Consumer Confidence will hit the tape at 10 a.m. Eastern. After the bell, you get retail earnings from Nordstrom. How tough is it for them on the streets? It's been a tough time for retailers. Tomorrow, SpaceX's Polaris Dawn spacecraft will make history and conduct the first commercial spacewalk, we anticipate. Some stock movers: Paramount. Producer David Ellison, Skydance Media, is set to buy Paramount finally after Seagram Edgar Brofman withdraws his bid. And there is only one event: the numbers and the conversation. For the context on the numbers, the CEO of NVIDIA, Jensen Huang, joins Bloomberg at 6:30 tomorrow.